I've had the pleasure of having a public conversation with Chamath a few times, and I tried a technique every time where I'll sort of ping him in advance, hey, do you want to talk about something? Each time he'll say, no, let's just go. And so I actually created a little list of things. So I'll let you, Chamath, pick.
You should talk about hard things.
What we're going to talk about first. I got 6 topics. You choose first.
Election, fake news, globalization, trade and immigration, role of Silicon Valley, filter bubble in tech, news, Twitter, etc., sports and athletes. Well, I feel like 1, 2, 4, and 5 are the same question.
Here, I'll start out with the more specific ones.
These are shitty topics. These are not hard.
Okay, let's start out with, so I've listened to your podcast about the election. In as dispassionate view as you can, which I know is hard, is the election good or bad or neutral for Silicon Valley and tech?
I think it's a multifaceted answer. I think I think broad-based, I would say it's actually quite good. It's probably the best thing that probably could have happened to us for the following reason, which is that there's a type of conversation that I think that's happening now that probably wouldn't have happened if Hillary had won. And part of it, I think, centers around this idea that we have cocooned ourselves into this nice, beautiful little existence that's frankly just detached from reality. And then separately, we were never forced to really understand the scope of the problems that we should have been working on. The real implication of that is I think you're going to see this probably in 2 or 3 years, where when the capital cycle starts to change, there's just been so many really poorly constructed businesses and business models that are going to be under pressure. So I think all of those conversations can now happen because of the election. So in many ways, I think it's probably like the most useful thing that could have happened. At a more moral and ethical level for a lot of people, I think it creates a lot of doubt and fear, and that's unfortunate. But I think the net balance is can be positive if you look at it that way.
And what do you think what's your view on the new administration's relationship either with Silicon Valley or the technology industry in general? And is there a role for the Valley proactively to play?
Yeah, I mean, I think if you look at the president-elect's tax plan, I mean, it's nothing but good news. If you actually are somebody, well, let me actually take a step back and actually talk about sort of the world as I see it. My big kind of like clarifying moment has happened sort of in the last few months along the following dimension. We do these really intensive portfolio reviews inside Social Capital, where we go very deep inside of our companies. And part of that was because over the last 5 years, we took a lot of these capabilities that we had at Facebook, which is where I and a bunch of my partners come from, and we built it into frameworks. And at first we were worried that those only applied at Facebook. All the things we did in machine learning, all the things we did in data science, all the things we did around paid acquisition. But over time we found that they applied to all these companies. We deployed it in all those companies that we work with, companies like Slack and Intercom, companies you know. And we collect these artifacts. And now these artifacts have been building up over years, okay? Incrementally, what we did was this is a long-winded answer, but I'll get there. Incrementally, what we did was we took all those capabilities and we stuck it on the web. We built this thing called the Magic 8-Ball framework, and we said, founders, get your shit together, get your head out of your ass, and understand your business. So you come to our website, it's like 3 or 4 clicks deep, but the point is, since we put these series of blog posts out, we've had, as of this morning, I looked, 3,400 companies run a Magic 8-Ball. And a Magic 8-Ball is effectively GAAP for a startup, right? Generally accepted accounting principles. So if you're a public company, how would you compare, for example, a public company in healthcare with a public company in oil and gas? Well, there are rules, and it's called GAAP. And it's how you, basically, report out your earnings, create balance sheets, and it allows you to make an apples-to-apples comparison across industries. Similarly, we felt that would be possible in startup land. Like, what is the difference between an enterprise software company and a consumer network effect business? Well, today, the easy answer is everything, they're all different. Our perspective is actually they're all quite similar, you just don't know what to look at. And so we tried to create this framework. So the long story is, We've collected this entire corpus of information. In a quarter, we're going to actually release a benchmarking tool out to founders that will allow you to understand how you measure on these very deep, nuanced metrics across thousands of companies. So how are you doing on LTV to CAC? Is that important? Maybe it is. How are you doing on 6-month retention? Is that important? Maybe it isn't. What about if you're the top 90th percentile in a certain category and the bottom 5th in another category? To know that is really powerful because you can now start to fix your business and know it. So we're sitting in a portfolio review, and I've been thinking that something is amiss, and what I see is degrading sales efficiency in some of our enterprise SaaS businesses. And this thing clicks. And I go off and I've been thinking about it, and I would come back to the following framework, which is there are really only 3 kinds of companies that get created in Silicon Valley. 2 are valuable and 1 is a category of complete dog shit. Category 1 is what I would call bits to atoms. So you're building something in software that then gets translated and manifested in the real world, in physical atoms, right? So what are examples of, let's use scale companies, okay? Amazon is a fantastic bits to atoms company. It started off as completely virtual e-commerce, but now they build more things in the physical world. They're buying boats and planes, they're building robots, they're building fulfillment centers. Tesla, another bits to atoms company. They have fantastic software and capability, but it manifests in batteries and engines and cars. Literally raw material comes in the front of the Gigafactory, Model X's come out the back. Apple, for better or worse, translates really great software into a fantastic physical product. SpaceX. And we've done a lot of these bits to atoms companies, and what I'll tell you about these companies is they are fundamentally defensible. Because they are hard, they're non-obvious, and most founders don't have the patience or the wherewithal or the sources of capital to actually go build them, and so as a result, they're quite unique. Those businesses in this new administration will absolutely thrive because you're going to have an administration that is going to be very pro-United States. And they are going to seek out companies and markets and businesses that basically promote Americans' excellence in things. And if you are building physical things, so for example, we have a company in Los Angeles that is constructing what will be the biggest high-precision 3D printer in the world. And we're using it to actually print a stage 2 rocket. So what is like a 65,000 part build will get reduced to literally 2 or 3 parts, which is preposterous, okay? But it's happening. But what I say is like, even if that works or doesn't work, the point is we can create a renaissance in 3D manufacturing in the United States. Airplanes, fuselages, wings, all kinds of things. Propellers, windmills, you name it. To think that the current administration will not be all over that business is naive. Of course they will be. So the fact that technology businesses can actually create a renaissance in things that, can build a stratification of job growth, right? Not just $200,000 software engineers, but all the way up and down the stack is a really powerful concept. That will win. There's another kind of category of business that I think is fantastic, which is what I call sticky bits companies. So what are those? Those are marketplaces, those are network effects, and specifically in enterprise, those are top-down system of record sales companies, okay? So what are examples of those? Facebook is an obvious one, Snapchat is one, Slack is another one. And those are really, really interesting kinds of businesses. Why? Because they're very hard to disrupt once they get going. There's an inherent flywheel and momentum that creates a usability moat or an acquisition moat or some kind of a moat that you can't necessarily just overcome with capital. And then, quite honestly, there's everything in the middle, which is everything else. And what you realize is that's a lot of companies. And some of our enterprise companies fall into that category, and I hadn't realized it. I thought that they were fantastic because their revenue traction was like this. And I thought, my gosh, this is great. $1 million of ARR, 3 million of ARR, 5 million of ARR.
How does that change the strategy when you're doing the portfolio review, and how do you communicate that to the founders?
I'll get to that in 1 second.
Okay.
So you hit a wall. And I think the reason is because those companies benefited from the fact that you could sell software with a credit card, right? But it was naive for us to think that all of a sudden somebody else could come in behind us with the same strategy to disrupt us. So before you had 10, 15 years to build a business. Now you have 4 or 5 years to build a business. It's not enough time. And you have to load your business up with sales and marketing and HR and PR and product marketing and customer success. All this infrastructure that is secondary to what you really have to do, which is fundamental core product market fit. Those businesses, I think, are in real trouble. And the reason why that's in real trouble is, again, I think is somewhat related to what's going to happen over the next 5 or 6 years. This administration has made clear, which I think is a fantastic thing, they're going to pump trillions of dollars into the economy. Trillions of dollars, literally with a T. Infrastructure spending, massive capital projects, that is going to be a renaissance of, I think, middle-income job growth. But what it's also going to do is going to inflate equities to a degree we probably haven't seen in a while. And so if you can get 15, 16, 17% IRRs in the public markets, why would you ever put your money into 10-year illiquid venture capital for the same IRR? It doesn't make sense. And so I think what actually happens is the following. Bits to atoms companies thrive because there's a manufacturing, a US first message that works. Sticky bits companies because they're capital light, highly sticky. The businesses in the middle must get very precise very quick because those companies will need to go and raise capital. But they will be faced with the following capital dynamic, which is that the public markets, like we have as much public market exposure as we do privates. And I struggle every day now to think about how I deploy an incremental dollar into privates for the same effective return when I should really just putting into the publics because I know the publics are going to rip. Because when President-elect Trump pours $2 trillion of money into the public markets, I'm telling you, the Dow is going to go like this, the S&P 500 is going to go like this, and it's liquid. So those dynamics, I think, need to be understood. And we typically don't even think about that. We don't typically think about what does Washington do or what could New York do to affect us. But that is what it's going to do. It is going to change the capital cycle because it is going to change the risk reward. The last 7 years have been that money is free, the public markets gyrate sideways, plus or minus, and the only return, perceived return, has been in private illiquid investing. The public markets are quickly catching up. Debt is going to catch up because we're going to see interest rates rise. All of these things have an effect in the real rate of return you can generate in our asset class, which, by the way, is not going up. It's actually flat to going down. And the reason is because for the last 8 years, we've had all this money flood in, and what used to be a $5 million A is now a $10 million A. What do you think happens when that? It's not as if the outcomes are also doubling. The outcomes stay the same, the prices go up, which means the return shrinks. So these dynamics, I think, are now going to come to the fore, and the next 4 to 5 years is how all of this stuff plays out. So that's a very long-winded answer, but that's what I think Trump means to Silicon Valley. It is a wake-up call, a sobriety check on rational company building, thoughtful business model construction, strategic operational guidance of a business, and that is in short supply.
So, I mean, that's a very interesting take. And this topic isn't going to be as interesting, but was curious from your experience at Facebook and then all the resultant sort of, I guess you can call controversy around Facebook and filter bubbles and fake news. What's your point of view on that controversy, and is there anything Facebook should do?
So look, I don't want to talk about Facebook, but I will talk generally about social media.
Sure.
I owe everything to Facebook. I'm loyal to those guys. Let's just call a spade a spade.
Yeah.
They have a difficult job, almost an impossible job. But let's take a step back and not talk about Facebook.
Let's make it feeds. So Twitter, Reddit.
Well, let's actually talk about social media in general.
Sure.
It is fair to say, and I think you can actually put Google in this category as well. Social media or user-generated content is modern feudalism. Okay, so let's call it that. You have 1.8 billion internet-connected individuals all around the world that are fastidiously doing the work, doing the hard work for companies that now are, tens of thousands of employees deep, not much more, to then monetize and then share that within themselves. Okay, so for example, let's look at Google. That's a $517 billion market cap company. The core escape velocity was PageRank. But how did PageRank work? PageRank didn't work because Google all of a sudden judged the quality of the search index. You did that work. And Google was just able to harvest that signal. Right? So you did the work, they built a $517 billion business. Most social media UGC companies, you upload the content, you annotate it, you create great, brilliant experiences, you don't get paid. The company that owns it gets paid. So the first thing we have to acknowledge is that there is a compact that has existed for a while that we probably didn't anticipate. And in that compact were some expectations. And now it's all coming home to roost. There was theoretically an expectation that us as a consumer was owed some amount of truthiness, quality, and SLA. And that was never in the SLA. That was never in the compact. The compact was you're going to do the work and we're going to make the money. And that happened. All the incentive systems. And this is not a company-specific thing. This is an entire industry classification thing. That is just the truth of what happened. So when we look at what's happening now, I think what we have to realize is those companies are in the job of making money. So when you look at how products are constructed, so now let's talk about feeds in general. And let's compare it to newspapers. So let's take media of the past, newspapers or television. They were time-bounded or physical space-bounded, right? So in the case of television, you had a 30-minute window. A show started, a show ended. There were blocks of time that were sellable. There was a message, but it has to get truncated in a fixed period of time. Let's take a newspaper. You sat down, you opened the paper on page 1, and it would end on page 10. So my point is there was scarcity in old media. And so you had to now actually have an SLA around the quality of the content because it had a direct correlation to engagement, which then had a direct correlation to monetization. We divorced ourselves from that expectation in new media because the first thing we did was we eliminated scarcity, right? There's a reason why feeds are infinite scroll, guys. There's a reason you can't get to the end of YouTube, right? And the reason is because it's directly correlated with monetization, right? There is one single economic formula that guides all of social media, which is clicks times eCPC. That's it. And so I think we just need to be really intellectually honest about what the compact is. We should have never been expecting truthiness. But if you do want truthiness, now I think is the time to demand it. But then the question is, what are you willing to do if you don't get it? And that's also that's a really difficult question that I don't think we also don't know how to answer right now. So I think social media in general has been constructed in a model that was purely about feudalistic monetization and capitalism, this modern form of something or other that is just the fantastical business model of all times, right? If you add up the entire market cap of all UGC companies, $1 trillion, $2 trillion, right? Globally. How many total employees? Less than 300,000, 400,000? I mean, that's preposterous. 2 billion people generating 2 trillion of value shared by 200,000, 300,000 people.
Do you think anything changes in either how any of the companies present content or how users behave, or this will just sort of...
So this is what I'm saying. So now I think we have to now shift and say, let's have a more first principles conversation about what we now know is actually happening. There is a monetization formula that dominates. And we have to ask ourselves, are we willing to compromise usability and quality of the product as it is today in order to get some of these other things? So as an example, there's a person that I think, for me, I follow a lot because he gives me the most truthiness of my network, which is Joe Lonsdale. Joe Lonsdale to me is like my sort of like keystone of truthiness. That guy finds unbelievably clear, clean, thoughtful content. And he shares it, both on Facebook and on Twitter. And so, does it change the usability of my product because I now don't look at my feed as much? I instead actually just search for Lonsdale, see what he's posted, and read that stuff? I do that.
Does it mean I miss a bunch of stuff? Yes. Does it make me more detached from the people around me because they're like, hey, did you see my great, awesome cat dressed as Luke Skywalker for Halloween? And I'm like, no, motherfucker, I could care less about your cat. I was reading about, whatever like Slate Star Codex had to say because Joe Lonsdale thought it was important, and I trust Joe Lonsdale's filter. So I have changed my mental expectation of what these channels should give me. It makes me less superficially connected to the people around me. It makes me more introspective and thoughtful about my worldview. That's not necessarily a fantastic formula for friendship. So how many people are willing to make that trade-off? Are you going to make that trade-off? Do you expect the services you use to make that trade-off for you? That's a very slippery slope. So I have no clear-cut answers. But I do think another solution to this is that there needs to be some of these products or sites, both offline or online, that need to be more operated as a public trust. And I think the most simple way to get back to a model of scarcity and content value that relies on an SLA is to basically remove this primary driver, which is eCPC times number of impressions. Which means if it was funded to not have to make money, now it could theoretically, at least focus on not generating clicks and views, but theoretically relaying content. And there should be sources like that. ProPublica maybe is one of those things. Slate Star Codex actually is quite good. And there's a bunch of these things, but they're hard to find. And they're really super long tail. And there's no efficient way to share it once you do find it.
So now to get even in a more insular topic, I spent a couple days in New York after the election, and I talked to a lot of old friends and folks in the industry. And they're all reading the New York Times, and they all seem very, very shocked. And so I started to think about, well, even in Silicon Valley, our media, there is an echo chamber. It might be on Twitter, it might be in the various blogs. Is there something that analogous to what happened on the coasts, for example, in early November, to what may happen in terms of the technology media landscape? Is our information filtered to a point where we don't see what's happening?
Yeah, of course. Oh, our heads are so far up our own asses, it's unbelievable. Yeah. I mean, it's not good, but it's the truth. I mean, for example, let's go back to how I started. There are three kinds of companies, right? Bits to atoms companies, sticky bits companies, and everything else. And if you actually go back and if we tried to run a classifier on the last 8 years and last $250 billion of invested capital, what do we think we'd find, quite honestly? We'd find very few of those bucket 1 and bucket 2 companies. We'd find a tremendous amount of things in this bucket 3 company. And part of what that speaks to is the fact that when things are easy, we pursue them because there's a fast feedback loop. And part of why that's happened is because we love fast feedback. It's no longer okay to win in 10 or 15 years. For most people now, in this perverse way, that seems like the end of life as we know it. The idea that one could work for 15 years on something. It's crazy. How could that be? It has to happen in 3 years. And instead I think to myself, doesn't it seem plausible that if you can build $5 billion of value in 2 years, okay, that could also just get destroyed in the next 2 years? Doesn't that stand to reason? If it was that easy for you, wouldn't it be that easy for somebody else to come in behind you? Of course. And so the thing is, we've gotten trapped in this culture, this iterative feedback loop of now. And so this is a fantastic moment in time where we can actually say, man, we have to divorce ourselves from this stuff. The world needs us to help do things that are hard. But too much of our time gets, unfortunately, redirected into the things that are easy and obvious. And the reason is because there's an entire infrastructure of people that want to basically congratulate you and reward you for short-term fake progress. And none of it is sustainable ultimately. And especially when there is a capital cycle. Most entrepreneurs right now, if just the volume, didn't even go through 2007, 8, 9, let alone 2000, 2001, 2. I've been through both of those cycles. And I'm telling you, like, I don't think we really appreciate what it's going to take to survive when the risk premia in venture doesn't justify the capital. And I'm telling you guys, we're headed in that direction.
Just as a quick counterpoint to that, I've heard for maybe the last 3 years, really smart market observers and investors saying the capital's starting to dry up. And you do feel it in certain follow-on rounds, but it seems like at the same time, there's more and more money coming in. And so if that continues to happen, does that mean that what you're predicting maybe will take longer to play out?
No, this is like, look, I think like you have probably 2 years of market highs in US equities. But things are lagging, right? Like money is always a lagging indicator. Like with respect to revenue, it's always a lagging indicator of value, and inflows are always a lagging indicator of risk allocation. And the thing is, like, you're going to look back, and in these next 18 months, it may be the case that that $100 billion fund that SoftBank was able to cobble together is the top. And you don't know in the moment. You only know in hindsight. And so all I'm saying is this is not meant to depress you. It's meant to clarify what you're doing. And the problem is twofold. One is the courage and the instincts to do things that may not necessarily go like this. But my gosh, I'm telling you, if you can compound 20% a year for 20 years, I'd take that 100 times out of 100 than this little thing. Okay, because this thing, honestly, as fast as it works, it can just fail. The other thing, though, is that then you need to find sources of capital who also understand that. And at least what I'm trying to vocalize to you is that there are some places out there of people who realize that working on hard things is better than working on easy things. And working on things that are sticky, that are non-obvious, that may take years and years, may be okay. Because once they get going, they'll get going forever. And oh, by the way, the ability for you to actually feel like you have the social capital to work on something for 15 years and it be okay is actually okay. And to not live, like the filter bubble you need to break is the one in San Francisco, which is like, oh, everything happens in 3 to 4 years.
Do you think that there's more opportunity?
And by the way, if you're not clear, look at like the last group of people you recruited and go and ask them how long they were there in the last few jobs they were in. I bet you it's 2 to 4 years max.
Yeah. Real quick, if you have questions, just line up here.
And the reason is because we've conditioned people to think about this as like, oh, everything has to happen in 2 to 4 years, otherwise I'm out. Then I'm going to go to the next company. Then I'm going to go to the next company. And this kind of mercenary approach to either being a founder or raising capital or being an employee is destructive, A, but it also is a path for us to be completely out of touch with what really needs to happen. There's a reason why SpaceX is going to be a $100 billion company, but guys, it's taken them 14 years. I mean, because it's hard.
Do you think that is a local mindset that gives an opportunity to other locations? Is that specific to this area?
It's a decision. It is a decision. It's a decision to listen to, what Gurley has said a lot, he and I are quite aligned on this generally. What I'm maybe saying now, for whatever it's of value, is to make hard decisions and then take the time to find the sources of capital that agree with you. And I think that really matters. And then separately, that's at this high level. But then practically speaking, to use metrics, to use data, to use things like our Magic 8 Ball to just show you the way. And then to be thoughtful about experimenting. Here's an experiment that we're currently running. As an outcome of this view, what I said to the team is, can you please go and figure out how we could maybe abstract all the sales and marketing from all of our mid-tier SaaS companies, and we will stand up a company and embed it into our growth team? And initially I get the same feedback. It's not possible. Only I can sell my thing. And I'm like, really? It seems to me Salesforce is selling 90 things better today than they did 10 years ago when they were selling one thing. IBM sells 150 things. Microsoft sells 9,000 things. And they just seem to be getting bigger and bigger and bigger and bigger. So you are fucking bullshitting.
And so what if we could actually just take all of the sales motions and generalize them and abstract them so that now a company can be even more leveraged and focused on their go-to-market. And now we can have best-in-class people, and we can actually staff those people all over the country. They can be in Ohio, they can be in Michigan, they can be in the Central Valley. You can't staff a sales organization here, guys. 200,000 fully loaded OTE for a startup trying to sell a product for a few $1,000 ACV, that dog doesn't hunt. Okay? You don't need to be a magician of Excel to figure that out. So these are like basic unit economic level discussions are not happening in enough scale. And so what happens? You get some ARR growth and you raise more money and then you unprofitably acquire more customers, generate more ARR growth, raise more money. That's not sustainable. So I think the thing we have to realize is like there has to be different, more creative, thoughtful ways of company building. There needs to be more practical quantitative insight, and you have to break this relationship with this theoretical romanticized notion of how success works in terms of time. It doesn't take 4 years. It may take 8, and it probably takes 12, so buckle in. Capital, doing more with less is always the better way. Sobriety around all of the things that matter versus the things that don't. I mean, this is the last time we talked about, kind bars and exposed brick walls don't matter. They will not be correlated to your success. And then working on hard things. Because the fast feedback loop, while it feels good and there's a dopamine rush initially, you must internalize that it creates equal and offsetting risk that somebody else can compete with you to do the same thing, but their motivations will be to do it cheaper, faster, and better, because that was your motivation to beat the incumbent that first allowed you to get that momentum in the first place. Right?
Great. So we're going to take some questions. If you have a question, just step up to one of the mics, introduce yourself, and a brief question, please. Go ahead.
Hi, Chamath. Victor from Care.Coach. So you talked a lot about working on hard problems and then Trump as well. I'm just curious what your views are on healthcare, given all that's happening.
There's been a couple of things that have been really negative tailwinds. There were some massive tailwinds in healthcare that have now become massive headwinds, and I'll explain a couple of them. One is at a state level and one is at a federal level. So at the state level, there were a lot of businesses that theoretically could have existed, but we've had California enact two things that are actually constructively quite negative. And I'm not here to debate whether you agree with them or not, I'm just relating some facts. Number one is around licensure of certain parties and business models that are in the periphery of healthcare. Not the hospitals themselves, but whether it's a skilled nursing facility, whether it's like the at-home care, there's a whole bunch of downstream things that are involved in the healthcare life cycle and keeping people well that are now more regulated than they were. Secondly, there's been also some very specific rules around compensation, minimum wage increases, and the way that you account for overtime and overtime payment. What that's done, unfortunately, as a practical matter in California, is there's a bunch of healthcare businesses that frankly now cannot exist. And as a result, what's happened is a bunch of black market activity on Craigslist. Second is, I think not knowing what the president is going to do around Obamacare and the ACA has slowed down and paused Medicare and CMS. Things that are related to it, whether they are insurance kinds of businesses, whether they are reimbursement, related businesses, I think are also now in deep, deep trouble. Now, let's talk about some tailwinds. But there are still some structural tailwinds that exist. Number one, theoretically, people are actually going to have more money in their pocket. There is a direct correlation with chronic disease and people having more money. So obviously we don't like this, but the reality is as we have more money through the tax cuts and everything else, diabetes will go up, cancer will go up, asthma will go up, obesity will go up. So those diseases will still unfortunately continue to compound its deleterious effects on society. Number two, there are just these massive personnel shortages that exist within the healthcare ecosystem that are not well serviced today. Nursing being probably the most important. So that's my kind of like short-term view, is that we're quite nervous about what the impacts to reversing some of the Obamacare policies are. But the good news is we actually have very little exposure to the Medicare, Medicaid type related businesses. And we still are in businesses that have some reasonably good tailwinds, particularly around chronic disease, that we still think has tremendous value, no matter what.
Sir.
Love your insights. You get me super fired up as an entrepreneur, so appreciate it. So I'm a San Diego company, and we just raised a round of capital. And one of the things that helped us close is we really communicated to our investors that we want to build a sustainable business. We should be cash flow positive this summer. We're not trying to shoot for a Series A or shoot for these crazy valuations. Are you seeing companies here in the Valley just only chase the valuations versus companies outside in markets that kind of get less attention?
Yeah, I mean, I think that what's happening is that there has been this culture where people, like, look, you know how they say there's this, what is this phrase, like, history is written by the winners? But the real thing is, like, there's a narrative fallacy, which is bullshit version of history is written by the winners. And the thing is, if you're going to write a story in hindsight, obviously you're going to project yourself as like this strapping, muscular winner, good looking, I can dance, I can dunk, I did everything right? You romanticize it, you bullshit. The problem is the N plus first person that hears it thinks, oh my gosh, they must be telling the truth. And so the effect of all of this is that you have had people chasing valuation because they think, oh, valuation means something. It means nothing. You know, there was a fantastic investor who told me, which I love, is like, why would you ever want your company valued at billions of dollars ever? He's like, I want it valued at zero until the last possible moment before we get liquid. And he's right. Why? Your employees make more money. You make more money. You take less dilution. You're more sober in your application. All of those things are good things. So to your point, yes, I do think we've kind of been chasing these wrong vanity metrics. You know, we used to chase registered users, then we realized it was MAU, then we realized it was down MAU. We've been chasing valuation, and we chase the post, and we think it means something. Guys, there's been less liquidity in the last 5 years than ever. None of these valuations mean a goddamn thing. They mean nothing. And we take them so seriously, and we pat ourselves on the back, and we think something real is happening. It's the blind leading the blind until these things get out. And the way to get out is to get profitable. Yep. There is no way to get out. So yeah, get to profitability. That's just awesome. Cool, I wish you the best of luck.
Yeah, thank you.
Yeah.
Cheers.
Sir.
Okay, so it seems that what you're attacking or being contrarian about is in fact all the people in this room and the startup ecosystem that is attempting to scale entrepreneurism. And the thing about pursuing things that are hard is that many less people are going to be able to do that. That most of these ideas are these little schmatty, stupid ideas, and Y Combinator loves that shit, you know?
Well, wait a minute, hold on. I think that that's not fair. And I'll say this, like, so I saw Sam yesterday. That's not true. Like those guys, like for example, like this space printing company was out of YC. Like the reason we're involved and the reason why he actually will tell you, he had to create a separate path for those companies because it is so hard for them to get any attention. And all I'm saying is it takes a different capital cycle. And what I'm telling you is there are actually more profits in those hard businesses than in these businesses. And so what we need is actually a reframing of how we think about value. And if you did that, it doesn't take $100 million to print this robotic arm business. The 3D printing business we're in was a $7 million check. It's no different than any enterprise Series A company. You know, we just did this fleet of autonomous drones in Alameda. Those drones that are in the water circumnavigating all the oceans, measuring fish stocks, oil spills, climate change, was an $8 million A. My point is, their go-to-markets are different. The way they construct the business is different, and it takes a different kind of investing lens, and I think it is possible to have. And we just have to create incentives that celebrate those people so that, to use your language, it's not just the schmaltzy stuff that we pump up and we say is what, because the person far away that's not here, when TechCrunch gives 50,000 page views to the schmatz and 1 page view to the drone company, guess what you're going to have? More schmatz. And that same person can probably build the next fleet of drones or cure cancer. And there are capital sources that can fund it. We have a lot of money that we can deploy at hard shit.
All right, but I guess the point being that the hard stuff, what you're talking about.
Or sticky.
All right, typically might need expertise and experience. And I don't have to tell you that people who are over 35 probably can't even get in the front door. That there's
that's so stupid too.
ageism.
Totally, dude. I totally agree with you. Look, listen, my whole thing is for every person that drops out, which is fine and good, there is so much value to working in a company. I worked at AOL. I worked at Facebook before I started my startup. And I felt way more prepared. I was a 36-year-old founder CEO. I'm glad I waited till I was 36. I had so much more knowledge because I learned beside people. I learned from people that were better than me. I also learned from people that were not as good as me about all the things that I shouldn't be doing. So to your point, I agree with you. This is what I'm saying. We need to divorce ourselves from this romanticized narrative, like fallacy that we've created, that it's this two dudes, 22 years old, dropped out of school, coded some schmatzy thing. That's not what success is about necessarily. There are some great examples of that where they're creating real value, but there's all of these other things. There's 40-year-olds, there's 50-year-olds, there's 35-year-olds, there's men and women, there's people doing all kinds of things that are not easy. And we have to find a way of like telling the world that this also exists and this stuff is worthwhile, because I suspect that the long-term solution for us being less tone deaf and for us actually being a constructive part of solutions is to celebrate these people.
Right, and so my own life, my own experience has been that software, the purpose of software is to actually change the world, and if you can make some money along the way, great. Unfortunately, in this world, you're only as good as your last IPO and how much money you made. A lot more money was made off of my company than I made. A lot of people made a lot of money, but in fact, we wouldn't have multimedia if I hadn't started that company. So at the end of the day, software is, it shouldn't be about waking up in the morning time, how much money can I make? It should be these hard issues that I'm trying to solve, and yeah, I'll make some money along the way. That's kind of been my philosophy.
That's a fair point. I think it's a really good point. Thank you for making
last question here.
Hey, Chamath. Jazz Banga, Aerospace Systems. So talk about solving hard problems, hardware, software, high-speed physics, and just drones at very high speed.
Bits to atoms.
Yeah, you got it. And so one of our challenges is it's all about talent, right? Like my number one job is just to get the best of the best talent we can get on board. Having a lot of challenges in that because we're fighting the Teslas of the world, the Facebooks of the world, the Googles of the world, and we're going to Canada. We're getting a lot of great talent from Waterloo. You know talking about. And so the problem is that we're worried about the immigration. A lot of these engineers and professors that we're grabbing from Canada are worried about this new administration, all the talk about yanking green cards and things like that. And what are you hearing about startup visas? And
to be honest, I really don't know. I haven't heard anything yet. Look, I think what's fair to say is I think that there's a view of American exceptionalism, which I think is actually quite constructive. And at the end of the day, it seems, I could be wrong, that Donald Trump is quite pragmatic and wants to win. Mm-hmm. And I'll just use a sports analogy. Like, if we want to talk about sports for a second. Like, when sports teams win, it's when they recruit the best. And what's amazing is like you get these people in, they come from all different backgrounds, and you get them organized, you get them running on the same strategy, and they win championships. And then if they're really good, they win multiple championships. And at some very basic level, what America has the ability to do, unlike any other country in the world, is to literally cherry pick the best of the best. And I think that'll be a decision that the government will probably make constructively, because I think if you take American exceptionalism to the extreme, why wouldn't we want to be the best? And if that includes people who want to legitimately be here, contribute their intellectual capital, monetary capital, we should find a mechanism and a way to do that. So I suspect that he's quite pragmatic about that stuff.
great, thank you.
Great. Well, as predicted, that was great. So thank you very much, Chamath. Thanks for everyone for watching, and we'll do it again sometime.
Happy holidays.